The dot-com bubble crash. In the late 1990s, you could launch a company with barely any revenue, slap.com, on the end of its name and watch investors throw money at it. Then in the 2000, it all came crashing down. Trillion of dollar in value vanished. Companies that were worth billion one year were worthless the next. Today, I will show you how the dot-com bubble inflated, why so many smart investors got swept up in, and exactly how it burst. Why the internet felt like a gold rush. To understand the bubble, you have to understand the excitement. The internet was genuinely new and genuinely world changing, and everyone could sense this. Investor reason. Whoever built the winning platform on this new internet economy will become massively wealthy. Nobody wants to miss out on being early to the next Amazon. So capital poured into anything internet related. Venture capitals funded new startup at a blistering pace. The stock market, especially the tech heavy NASDAQ, NASDAQ, absorb all of that enthusiasm. And it's in the roughly between the mid 1990s and its peak in the early 2000s. Genuine excitement about the internet's potential drove huge amount of money into any company associated with it. The problem, hype outran fundamentals. Here where it went wrong. Normally, a company stock price reflects some exceptional of future profit. During the dot-com era, the connection broke down. Many of these companies had no profit, sometimes barely any revenue. Business plan built more around gaining market shares or eyeballs than making money. But investors brought in anyway, betting the profit would eventually follow some days. Simply adding .com to a company name could sometimes boost its stock price, regardless of what the business actually did. The useful way to think about it, normally price is supposed to track value. During the bubble, price mostly tracked attention, and attention is not the same thing as the second business. Stock price soared based on hype and attention, often completely disconnected from whether the companies actually made money. Fuel on the fire, cheap money, and easy IPOs. A few other ingredients made the bubble bigger than it otherwise would have been. Easy access to public markets, companies with a little more than an idea and a website could go public through an IPO and raise huge sum almost overnight. Sometimes seeing their stock price double or triple on the very first day of trading. Cheap capital. Interest rate and financial condition in the late 90s made it easy for venture capital public investor to keep funding unprofitable companies on the assumption the profit or at least an eventual buyer would show up later. Media and retail hype, financial televisions, magazines, and a new wave of retail investor trading online amplified the excitement, creating a feedback loop where rising price attracted more buyers, which pushed price even higher. Easy IPOs, cheap capital, and media hype all fed the bubble, creating a self reinforcing cycle of rising price. The burst. The Nasdaq peaked in March 2000, and then the story started to unravel. A few forces converged. Many dot-com companies began running out of cash since they had never built the revenue to sustain themselves without constantly raising new funds. Investors slowly started asking harder questions where the actual profit. As sentiment shift, money that had been pouring into speculative stocks began pulling back. Once price started falling, the same hype driven moment that pushed price up worked in reverse. Declining price spooked more investors into selling. Over the next roughly 2 years, the Nasdaq lost about 78% of value from its peak. Countless dot-com companies went bankrupt entirely, and even fundamentally strong tech companies saw their stock price collapse along the speculative ones. Once confidence cracked, crash burning companies collapsed at the same moment that inflation price reversed, wiping out roughly three quarters of the Nasdaq value. Who surveyed and why it matters? Not every company died. Some like Amazon and eBay survived the crash, even though their stock price fell dramatically during it. The difference tended to be real, durable business model with the genuine path to profitable, not just high. The crash had lasting effect. It wiped out a huge amount of speculative capital, making investors far more cautious about funding unprofitable startups for years after that. It contributed to a broader US economy slowdown in the early 2000s. It reshapes how venture capital evaluated startup, putting far more emphasis on actual business fundamentals. In some way, the crash cleared out the excess. The real internet economy that followed was built on the survivors and on lesson learned from what had done wrong. Weak companies with no real business model collapsed, while a handful of survivors with genuine fundamental went on become internet giants.